April 2022 question number 4D, 𝗕𝗙𝗪 Manufacturers Limited. Current EPS is 5. The current EPS is 5. The company has an asset beta of 0.9. Asset beta is the ungeared beta, and adopts a 40% dividend payout ratio as its dividend policy. The risk-free rate of return is 5%, and the equity market risk premium is 10%. The management of 𝗕𝗙𝗪 Manufacturers Limited intend to undertake a financial reconstruction which will result in a debt-to-equity ratio changing from 0.15 to 0.3. Debt is considered to be risk-free. Corporation tax applicable is 30%. Required, show the impact of financial reconstruction on the WACC of the firm. WACC of the firm. Impact of financial reconstruction. Remember, this is capital reconstruction where we are doing like a debt equity swap. So we expect the debt equity ratio to change, right? So basically, this kind of a question is not a tough question. You can see the first thing that I'm able to pick here is that they've given me the ungeared beta. They have given me the ungeared beta, what we also call assets beta. What we call assets what here? Assets beta. Assets beta. Yeah, we normally abbreviate this as what here? As BEU. So once you give me this assets beta or ungeared beta, the very first thing I'll do is to convert it to what we call geared beta. Convert to geared beta. Convert to geared beta. What we call in this case here, BEL. You see, geared is the same as what here? Levered. Yeah, levered. 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 Levered or leveraged. One and the same. Yeah, levered. Very, very important for you to know this. And the formula of a conversion of this ungeared beta to geared beta is what we call the 𝗕𝗙𝗪𝗔 model. So we have here the 𝗕𝗙𝗪𝗔 model. So remember 𝗕𝗙𝗪𝗔 model. 𝗕𝗙𝗪𝗔 model. So 𝗕𝗙𝗪𝗔 model, what do we have under 𝗕𝗙𝗪𝗔 model? We know the formula is BEL equals BEU into 1 plus debt to equity ratio, but adjusted for taxation like that. Adjusted for taxation. So first, go ahead and give us BEL before reconstruction. Before reconstruction. So before capital reconstruction. So before capital reconstruction, I want to get this BEL. Beta assets has been given. And this never changes. Beta assets has been given. They have told us in this April 2022 that the beta assets, if you look at sentence number 2, the beta assets is 0.9. So beta assets is 0.9. Into 1 plus debt to equity before reconstruction. The debt to equity before reconstruction, if you are very keen, second last line. The second last sentence, the second paragraph actually, the management of 𝗕𝗙𝗪 Manufacturers Limited intends to undertake a financial reconstruction which will result in a debt to equity ratio changing from 0.15 to 3. So it means that this 0.15 is the old, debt to equity. And then the 3 is the new debt to equity. So this one is before reconstruction, and this one here is after reconstruction, after reconstruction. All right. So then here I'm looking at BEL before reconstruction. So it will be 1 plus debt to equity. So the debt to equity before reconstruction is 0.15 times, we know tax is 30%. So 1 minus 0.3, so 1 minus T will be 0.7. So times 0.7, like that. And then ensure that you pick your calculator yourself and do the punching. So you say 0.9 times, open brackets, 1 plus 0.15 times 0.7. Yeah. And then you get this one as 0.9945. Thanks, Ibrahim. 0.9445. Is there someone else who is able to confirm this? Bahati has confirmed yes. Bahati has confirmed yes. Bahati has confirmed yes. The lucky man. Great. So up to here, ladies and gentlemen, all of us, are we okay up to here? Are we okay up to here? Yes. Thank you so much. So then, having gotten bell, what do you think will be the next thing to be determined, to be ascertained? Having gotten bell, we know the natural cousin. We know the cousin of bell. The cousin of bell is 𝗕𝗙. So go ahead and give us cousins, 𝗕𝗙. So 𝗕𝗙, we are using 𝗕𝗙. 𝗕𝗙, we are using 𝗕𝗙. Yeah. Oh, it is 0.9999. Thank you so much. It is 0.99. Thank you so much. 0.9945. 0.9945. So 𝗕𝗙, we are using in this case here 𝗕𝗙, so it will be risk-free plus 𝗕𝗟𝐻 minus risk-free, in this case here multiplied by bell, like that. Multiplied by bell, like that. That's 𝗕𝗙 formula. Cost of equity, the 𝗕𝗙 formula, cost of equity, you take risk-free plus, into brackets here we have 𝗕𝗟𝐻 minus risk-free multiplied by bell. Now remember, we are getting all this before reconstruction. So has this examiner given me the risk-free rate of return? Oh yes. In paragraph number 1, the last sentence. Paragraph number 1, the last sentence, the risk-free rate of return is 5%. Risk-free is 5%. So risk-free is 5%. Has he given me the market return? Market return? No. Instead of him giving me this market return, he has given me the premium. Remember, premium is after you subtract. So whenever they talk of premium, please remember this, that whenever they talk of premium, it is this deducted, like that. Premium means over and above. Over and above. So like in this case here, they have given me the equity market risk premium is 10%. So whenever they use the word premium, please know that they have subtracted for you already. Already subtraction has been done. So they have subtracted for me. So this is 10%. Multiplied by our bell before reconstruction, which is 0.9945, like that. Yeah, so Eric Bill, they're giving me 14.945. 14.945, like that. 14.945, like that. Yeah, great. Now, ladies and gentlemen, having gotten that, I know that the next thing should be for me to come and give my examiner, Wakaka. Because remember here, they wanted me to do what here to get the impact on the WACC, not PO, not share price, but WACC. So then I would want to get, in this case here, the WACC before reconstruction. Let's get WACC before reconstruction. We get WACC before reconstruction. Let's get WACC before reconstruction. So how do we get WACC, weighted average cost of capital? So remember, this is weighted average cost of capital. Very easy to get it. WACC will be equal to weight of equity, cost of equity. Yeah, plus weight of debt, cost of debt, adjusted for taxation, like that. So before reconstruction, remember, our debt to equity is 0.15. It is out of this debt to equity that I should be able to get the weights. Sorry, this WE. Good to assume that you don't know these things. This is weight of equity, which is E over D plus E, weight of equity. Then we have weight of debt. Which is D plus E. E is equity, D is debt. D is debt. So you see your examiner has given you D over E, but he has not given you like D over D plus E. Yeah. So in this case, it will be very important for us to get weight of debt. How do we do that? We know, ladies and gentlemen, that whenever you see a number like this, just any whole number, it has a fraction here. Or rather, if you want to divide and still retain the same number, it will be this divided by 1. Any number, whenever you see any number, it has got a 1 as a divisor there. 1 as a divisor there, 10 over 1. Yeah, so D over E. So this is the same as saying 0.15 over 1. Yeah, so meaning that D is 0.15 and the equity is 1. And therefore, weight of debt, which is debt over debt plus equity, yeah, debt, all over debt plus equity, yeah, please somebody answer that ninja there. Yeah, will be equal to what here? Somebody will be equal to the debt. The debt, I know the debt I have here is 0.15 over the debt again, 0.15 plus 1. Yeah, which will be the same as 0.15 over 1.15, which will end up giving me what figure? Yeah, so Eric is giving me 0.1304. 0.1304. Yeah, the more the decimal places, the better. The more the decimal places, the better. So then having gotten weight of debt, what do you think shall I do to get weight of equity? We know that weight of debt and weight of equity will be always equal to 1 when you add them. So then the weight of equity will be 1 minus this weight of debt. 1 minus the weight of debt. 1 minus weight of debt should be 1 minus 0.1304 like that. Which will end up giving us what figure, ladies and gentlemen? 0.8696. 0.8696. Yeah, very, very important. But getting this gearing, you must be very, very careful. Very, very few students in this case here get to know how to calculate gearing. This is known as gearing ratio. This one here. This one here, the weight of debt is known as gearing ratio. Gearing ratio. Now, this is how we calculate it very, very fast. This is how we calculate it very, very fast. If you give me debt to equity, if you give me debt to equity ratio, if you give me debt to equity ratio as 0.15, I will simply gear this up very fast to get weight of debt. To get weight of debt, which is the same as gearing ratio. What I will always do, I will take this one as the numerator the way it is. Yeah, take this one as the numerator the way it is. So 0.15 over geared, this value geared. We talk of geared, you add 1 to it. So you add 1 to this one. So if I add 1 to this one, it will be 1.15. Yeah, it goes over and above 100%. Yeah. So very easy. Let me explain something. If you go to an exam, first of all, confirm, will this give us the same answer? Will this one here give us the same answer? Let's first of all confirm this. Weight of debt will be 0.15 over 1.15. The bottom one is geared. Yeah, bottom one is geared. Yeah, great. Let me see whether my students are following. Let me see whether my students are following what I'm talking about, this concept of gearing, the weight of debt. What if, ladies and gentlemen, you are given something like this? That debt to equity is 0.25 without thinking. Can you kindly give me the weight of debt without thinking? Without thinking. Can you kindly give me the weight of debt without thinking? If debt to equity is 0.25 without thinking. Yes, 0.2. Yes. What have they done without thinking? So in this case here, what they have done, they have simply taken this number divided by the geared number. Geared, you add 1 to this, 1.25. That's what they did. That's what they did. Don't write this anywhere, which gave them 0.2. Now, having gotten 0.2, then what do you think will be the weight of equity? Yeah, because the 2 must always add up to 1, isn't it? The 2 must always add up to 1. So the weight of equity will be 1 minus 0.2, which is 0.8. Is that clear, ladies and gentlemen? Is this clear, ladies and gentlemen? Is it clear? Is it clear? Is it clear? Don't let me down, because this will always be tested. Always, always. That concept of gearing will always be tested. So if you go to an exam, and then you get the examiner telling you, hey, I have D over E of 3. Then what is weight of debt? What is the gearing ratio? What is weight of debt? Weight of debt. Weight of debt will be equal to something over something. The numerator remains. The denominator, we have to uplift the denominator. Yeah. So always you add 1. Yeah. Without thinking, it becomes very easy. Thank you so much. So now we have everything. Let's continue with our WACC before reconstruction. WACC before reconstruction. And we have said it is weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. So the weight of equity in this question, we have it. It is 0.8696. Is there somebody who can remind us what the cost of equity levered, the one that we got up there? Cost of equity levered, the one that we got up there, somebody who can remind us? So what figure do we have there? Cost of equity levered. Where the computer did. 0.9945. 0.9945. Weight of debt, we know it is 0.1304. Who can give me the cost of debt in this question? Cost of debt in this question. Sorry, let me just see. You can see there's a question. Yeah, good question there. Good question there. I'll be able to answer that. Good question there. Good questions there. So in this case here, they have told us that cost of debt is the same as the risk-free rate of return. Cost of debt is the same as risk-free rate of return. Did they tell us, or we assume? Let's see. The risk-free rate of return is 5%. That sentence, before tax, they have told us debt is considered to be risk-free. Debt is considered to be risk-free. Debt is considered to be risk-free. Now, okay, great, they're doing. Let's correct something here. Is this the value really for cost of equity, this one? Or are you guys giving me the value of Bell? Let's correct this. Is this the cost of equity really? Remember, KE is cost of equity. KE is cost of equity. It is 14.945. 14.945%. Please correct. Yeah, plus 0.1304 times cost of debt, which is 5%, which is the same as risk-free. Times this 1 minus t, we had ascertained this as 0.7, if you remember. 1 minus t was 0.7. Yeah. Yeah, great, great. So then at the end of the day, we are getting 13 point what here? 13.45. 13.45. Is that okay, ladies and gentlemen? Is that okay? 13.45 is correct. 13.45 is correct. So from Madam 𝗕𝗙𝗑, she's asking there, if debt to equity is 0.85, how is equity 1? How is equity 1? Very simple mathematics. Look at this, 𝗕𝗙𝗑. Remember any number in mathematics. Whenever you see any number like this, all right? Whenever you see any number like this, it will always have 1 at the denominator, always. Because you see 0.85 divided by 1 is 0.85. And then now you equate. You can see debt is the numerator. So debt here will be 0.85. Equity will be this 1 here, like that. All right. And then now if you want the debt to equity ratio, debt to as a weight of the capital structure, you do it like this. So it will be 0.85 over the debt, which is 0.85, plus equity, which is 1. So it will be 0.85 divided by 1.85, like that. If you make that argument, we are trying to make it, you'll always be wrong. You'll always be wrong. Why? Because your examiner will come and tell you that the debt to equity ratio is 2. Yeah, and you see, you know that weight of debt plus weight of equity must always be equal to what? Yeah, must always be equal to what here? Must always be equal to 1. So you see, this already is exceeding 1. This already is exceeding 1, all right? So debt to equity ratio is not the same as weight of debt. No. Weight of debt is always what here? A fraction. Is always a decimal. Is always a decimal. Is always a decimal. Yeah. So some students are asking where we got the 14.945. Yeah. How we got 14.945. Those are very good students that are asking very, very good questions, but I want them to be very honest with me. Did they come to class late? Did they come to class late? Just be honest and then I'll repeat. Did you come to class late? Be honest with me. Be honest with me. Yes, you came late. You came late. Then I will be able to explain. Don't worry. I'll be able to explain. Don't worry. So in this case here, we have here 13.45. So for me to be fair to everybody, yeah, what I'll do, I'll be able to explain how I got this cost of equity levered using the next step. You see, the next step is after reconstruction. So in this case here, let's get the WACC after reconstruction, and the M will be very comfortable. So in this case here, let's get WACC after reconstruction, and I'll be able to take now some few minutes here to explain better how we're getting this cost of equity after reconstruction. The thing here is, I have the debt to equity after reconstruction. We have it. Is there somebody who can see it is 3? Debt to equity ratio after reconstruction. Is there somebody who can see it is 3? Yeah, we're given in the question, this question we are doing here of April 2022, question number 4D, we are told here, second paragraph, the management of Viwanda Manufacturers Limited intends to undertake a financial reconstruction. Yeah, capital reconstruction, which will result in a debt to equity ratio changing from our initial 0.15 to a new 3 not 3, to a new 0.3. I'm sorry here. So this is supposed to be 0.3. 0.3, yes. That is a new debt to equity after reconstruction. Ladies and gentlemen, remember they have given me the ungeared beta. They have given me the ungeared beta. This never changes. Ungeared beta is also known as, for the students who came in a bit late, this is known as asset or beta assets, one and the same. Beta assets. Beta assets. If you look at paragraph number 1, Viwanda Manufacturers Limited current EPS is 5.0. The company has an asset beta of 0.9. That asset beta is what we shall fight. We don't work with asset beta. No. We must change this asset beta, also known as an geared beta, to the geared beta or to the leveraged beta. So that is the first war. So the first war here for us to be able to get KLJM, come and give us, use �値𝗓𝗪's model, use �値𝗓𝗪's model to get, well, beta equity levered. Yeah, to get beta equity levered. Use �値𝗓𝗪's model to get beta equity levered or geared. How do we do this? Very easy. BEL equals BEL into 1 plus D over E into 1 minus tax, like that. Yeah, BEL equals BEL. BEL is beta equity unlevered or ungeared, which is 0.9. Into 1 plus debt over equity after reconstruction is 0.3. The 1 minus tax, we know this one is 0.7 because you see tax has been given there as 0.3, 30%. Therefore, 1 minus t will be 1 minus 0.3. That's how we got the 0.7 like that. Yeah, so you move slowly with your calculator. You say 0.9 times into 1 plus 0.3 times 0.7. Okay, there is a question here. For the 5th time, we shall be able to address that. I'm so sure it is body mass. Don't worry. We shall address that with this one and we'll be able to bear witness. You'll be able to understand it. So in this case here, I hope you have been able to punch this one by yourself. Now we are getting 1.0889. 1.088. I'll always work with 4 decimal places. The more the decimal places, the better. The more the decimal places, the better. So now, ladies and gentlemen, it's cousin's game. Once I get Bell, I know I have to calculate the figure of the other cousin. So once I get Bell, I have to calculate 𝗕𝗏, isn't it? Here we calculate 𝗕𝗏. And the 𝗕𝗏 is a very good cousin. We normally use what we call CPA. Yeah, capital assets pricing model. This person will say that if you are rich in this world, you must always mix your capital assets. Yeah, you must always have, in this case here, government bonds, risk-free. Always. If you don't have them, then don't tell us that you are rich. Yeah. So in this case here, we have here CPA as, so I will be able to get risk-free rate. And then I'll be able to get my market returns risk. These are basically risky assets. Yeah. So minus risk-free. And because they're risky, then we must come and multiply with the risk factor outside here, the Bell. Like that. So, and remember, this is after reconstruction. So the Bell must be Bell after reconstruction. So rate of risk-free does not change. The risk-free rate is what percentage here? 1.089. Sorry, 1.089. 1.089. 1.089. Sorry for that. 1.089, like that. So then risk-free, I'm being told here is 5%, isn't it? Risk-free, I'm being told it's 5%. Remember, they have given us the premium. They haven't given me market returns. In this question, they have given me the premium. And the premium means that they have already subtracted for you. This is what we call the risk premium. They have already subtracted this for you, and they're calling it 10%. Don't subtract again. So this is 10% into my beta equity levered, which is 1.089. So M, please use your calculator and ensure you're able to follow this very well. Yeah, don't say equals anywhere. So say 5 plus 10 times 1.089, and then you say equals after you've finished everything. You say equals after you've finished everything. M, I would want to see whether you're getting these things. So they're getting 15.89. So this is 15.89. So JM, this is what we did initially for us to get this 𝗕𝗏. Except for the fact that that was before reconstruction, and we were using a Bell before reconstruction. But now with this and the video, which you'll get on to believe you'll be able to follow, JM will be able to follow. So after that, I would want you guys to do me a favor. Now I want, to get WACC, I want the weights. I would want to see serious ninjas. I would want to see serious ninjas giving me the weights. Serious ninjas now should be able to give me the weights from this debt to equity. Remember, debt to equity is 0.3. Yeah, so I would want to be told what is the weight of debt and what is the weight of equity. These serious ninjas. Weight of debt is 0.2308. That's from Eric. 0.2308. And then the weight of equity is 0.7692. 0.7692. So basically to get this, they took 1 minus this. They took 1 minus that. They took 1 minus that. They took 1 minus that. Yeah, thank you, Maggie. I can see you are great. We have a Pogisho here. Yeah, Pogisho used to be a minister, serious minister. Yeah, weights. So this must be the son or the cousin. They must be related. Those are rare names. Great. So all of us, are we comfortable with this? Or is there somebody who wants Mwalimu to do these weights? Is there somebody who wants Mwalimu to do the weight? How we get the weight? Okay, no problem. Jelagat, I'll be able to do that. So how we got this weight? This is really an easy thing. It's because of this. Whenever you're told debt to equity is 0.3, you just know that there is an over 1 automatic there, over 1. So that debt will be 0.3. So debt, so this is debt, 0.3. And then of course, equity is 1. And then of course, weight of debt, you know, this is debt over debt plus equity. Yeah. So the debt here, the debt is 0.3 over debt 0.3 plus equity of 1. So then this will be 0.3 over 1.3. Just try that and you'll be able to see, in this case here, what is happening there. You'll be able to see weight of debt is 0.2308. So always, whenever you see debt over equity is 0.3, there must be a 1 there. Once you pick it like that and then you separate, you say then debt is 0.3, equity in this case here is 1. Then you'll be able to get weight of debt, which is debt over debt plus equity, like that. But now remember, there is a shortcut. There is a shortcut to this. The shortcut, you simply look at the D over E given. Whenever you see the D over E is 0.3, then to get weight of debt gearing ratio, you take 0.3 the way it is, all over 0.3, the same number, plus 1. Always you add 1. Don't ask me where the 1 is coming from. You always keep on adding 1. So then this one will be 0.3 over 1.3. So if you're told that debt to equity, for example, is 4, and you want to get weight of debt, you take 4 all over the same 4, but for the denominator, you must always add 1. You must always add 1. So then this one will be the same as 4 over 5. 4 over 5. So are we together now, ladies and gentlemen, all of us, as to how we got these weights? Are we together as to how we got the weights? Understood. Thank you very much. Great. Now from there, ladies and gentlemen, I will be able now to come and give my examiner the WACC. I'll be able to come and give my examiner the WACC. WACC. We know this is WACC. And to get WACC, we take the weight of equity, cost of equity, weight of debt, cost of debt, into 1 minus tax. So the weight of equity already is given 0.23. No, 0. I rubbed mine, unfortunately. It was 0 point something, isn't it? 0.76, yeah. 0.76, 0.7692 times cost of equity levered. This scale, we had it somewhere. This scale, we have it somewhere. It is here. It is 15.89%. The weight of debt, we have it. Weight of debt is 0.2308. KD, they have told us that KD is the same as risk-free, which is 5%. KD is the same as risk-free, which is 5%. So times 5%, like that. Which then will end up giving us what figure, ladies and gentlemen, as our WACC 16. Yeah, you see, like M, when you are repeating this, I'm 100% sure what students will do. Just go slowly. Say 0.76, times 0.7 here. Yeah, 1 minus tax. Yeah, I'm so sure what many students will do is to come and put all these under taxation, which will be very, very wrong. Yeah, remember body mass, you're first of all supposed to multiply, right? You can do this multiplication aside, you do this multiplication aside, and then you add the two numbers. The other option, ladies and gentlemen, is to simply come and follow this to your calculator. You say 0.7692 times 15.89%. Don't put, in this case here, equals anywhere, plus 0.2308 times 5% times 0.7, and then you say equals at the end of the day. Then you'll be able to get the correct answer. M is not your calculator. It is you who is not following body mass. If you follow body mass very well, then you will be okay. You will be okay. So I'm being told that the answer here is 13.03%. Is that the case for all of us, ladies and gentlemen? 13.03%? Yeah. How I wish I would get the feedback from M, that student called M. How I wish I would get the feedback from that student, but now they are comfortable. Yeah, great. So then in this case here, what was the old WACC? The old WACC before reconstruction? The old WACC before reconstruction. Is there somebody who can remind us? This one here was equal to what here? 13.45. So then in this case here, capital reconstruction, capital conclusion, capital reconstruction has led to a reduction in WACC from 13.45% to 13.03%. This is good for the business. This is good for the business. Whenever your cost of capital reduces, you feel happy. This is good for the business. Yeah, so the impact in form of percentage, this is what they always look for. Impact in form of percentage. Yeah, you take the new minus the old. So new minus the old all over the old times 100%. Can you kindly give me this percentage reduction? The percentage reduction. So the new WACC is here, 13.03%. You can ignore the percentages, eh? Yeah, can ignore them. Minus the old one, which is 13.45%, all over the very old 13.45%, and then you are done. Yeah. Kibara, okay, sorry. Yeah. You can easily confuse ladies around, isn't it? Yeah. We shall overcome. So I'm being given what percentage there? Minus 3.13. Minus 3.1, minus 3, minus 3.123%. Meaning that our cost of capital reduced by 3%, which is very, very good. Yeah, remember it is new minus old all over the old, always, yeah, always. Whenever you are asked to get a price change, the cost of bread today, bread could be going for 50, I'm not so sure. And maybe, so this is the old price 50, and then the new price 60. And then somebody wants you to get the percentage change. How do you get percentage change? It is always new, which is 60, minus old, 50, divided by the old. Always, old is the base, always, times 100. Great. So can we continue, ladies and gentlemen? Are we okay with that question now? Yeah. Shall we pray it comes in our exams? Shall we pray it comes? I wait for a minute, okay. Shall we pray it comes now? I've done 3 questions. I've done three questions in this same area. 3 or 4, I don't know. 3. Yeah, this one should come. And people fear it for nothing. And every time it comes, and I've never understood my students at times, of course, again, I can't blame you because as usual, we are teaching in this case here, not the very young students. You don't have time. That is the truth of the matter. You don't have time because every time they bring it, they repeat everything the same, everything, the language. Look at, for example, November 2018, question number 1B. November 2018, question number 1B. Yeah, thank you, Liaka. Great. November 2018, question number 1B. They bring exactly the same content. They only take few figures here, they multiply by 3, by 2. Yeah, November 2018, question number 1B. Let's see whether you guys have been able to get this question. Once you get it, please put your thumbs up like this. November 2018, question number 1B. November 2018, question number 1B. It's amongst these 𝗕𝗙𝗪𝗔 model. You'll get it in your exam. It can't miss. It cannot miss. It cannot miss. This is just like the foreign exchange. Yeah, risk management, very, very important. So have you gotten, ladies and gentlemen, the question? Yes, 𝗕𝗚𝗎𝗙, isn't it? 𝗕𝗚𝗎𝗙 Limited. 𝗕𝗚𝗎𝗙 Limited, yes. We are told 𝗕𝗚𝗎𝗙 Limited is considering undertaking a financial reconstruction during which it would repurchase its outstanding ordinary shares using debt. This will raise its debt to equity ratio to 1.2. The following information was available for the company. Existing debt to equity ratio is 0.8. The asset beta, which is an geared beta, is 0.3. The risk-free rate of return is 8%. The return of the market portfolio is 14%. The company adopts 50% payout ratio as its dividends policy. The company expects to generate EPS of 6. Debt finance is considered to be risk-free. The corporate tax is 30%. Yeah. Evaluate the impact of financial reconstruction on 𝗕𝗚𝗎𝗙 Limited's WACC. Is it something you guys can, or rather think you can do later? Perhaps you can just try putting it down and then you send your answer on WhatsApp for marking. Yeah, it is the same. So long as you remember before reconstruction, after reconstruction. And most of the information we give you here is very, very useless. Like that information about EPS being 6, dividend payout ratio being 50% will not be used. Because here they have not asked about PO. No information about PO is needed. We are just putting it there to confuse you. Here it is reconstruction, impact of reconstruction on WACC. We try it ourselves, and then should we, in this case here, fail to get it, Mwalimu will be able to do this in his next lesson, I promise. But try. I know you don't have the time, but just try that one. Now that I've told you, it may come in your exams. Just try it. Now, there is a student who asked in this case here, when in this case here do we ungear beta? There's a student who asked here some time back, when do we ungear beta? So ungearing beta, I'm so sure you'll be able to do this one in financing decisions. This concept of ungearing beta normally happens when we have mergers between two firms. Yeah, you have in this case here a firm going into a new industry. A firm going into a new industry, that one you shall be able to do it later. It's beyond the scope of this particular what-year session. But in future, should you feel that I should do that area, I don't have a problem. I can do it with you. But for now, please, in this case here, mention there, measurement of bankruptcy levels. Measurement of bankruptcy levels. For us to be able to talk about reconstructing organizations, we must know how do we measure bankruptcy levels. We have various models, Altman's model, etc. But today, I would want to do this model known as SPRIN. SPRINGATE model. SPRINGATE model. Right there, SPRINGATE model. SPRINGATE model. Yeah, somebody should be able to help 𝗕𝗙𝗪𝗙, we know here. Yeah, November 2018. SPRINGATE model, is that the question really? How did you know it's November 2018? How did you know it's November 2018? You must be crazy. You must be crazy, people. Crazily bright people. How did you know that is the question I want to do? No, the one I want to do is December 2021. The one I want to do is December 2021. Question number 3. December 2021. So we get to see here how this SPRINGATE has been used to evaluate. Question 3. How this SPRINGATE has been used to evaluate bankruptcy of an organization there. Oh, the assignment, yes. Sorry for that. Yes, assignment in December 2021. Question number 3 is the one that we are doing here. Once you get the question paper, kindly, as usual, put your thumbs here to show that you are ready to tackle the question. Thumbs up to show that you are ready to tackle the question. And today you guys are very, very many, which is really good, which is really good, which is really good. Very good, very good. And you can see in this case here, Zoom has introduced very good new features that you can now send non-verbal feedback using the emojis, like yes, slow down, etc. from reactions on the tool. When you see these reactions, I hope you're able to see the reactions. Reactions, they are very, very important. Yeah. Instead of asking so many questions and maybe Mwalimu is moving very fast, what do? You simply tell Mwalimu, in this case here, to slow down. Yeah, great. I love these Wazungus. They are very innovative. Great. So we are told there, it is part C. We start with part C. This is what is testing Springate. Springate. Sometimes students call it Springate, not Springate, Springate. So we are told the following data relates to 𝗕𝗙𝗠 Limited, a company that operates in the manufacturing sector for the year ended 31st December 2020. Great. So they're telling us that the company is currently paying interest on a long-term debt instrument amounting to 905,000 per year. And that the company's total liability is constituted in the ratio of 2:5 between current and non-current assets. Using Springate model, assess the financial health of the company. Okay, great. Great. They weren't aware. That class is permanent. Every Sunday at 7 a.m. 7 a.m. So should be having somebody who should be preaching that gospel in class there. Thanks, Mary, for that. So you see, these are very, very useless questions in AFM. Why are they useless? Because the examiner will always give you formulas. Basically, we are testing your ability to follow a formula. Yeah. So like now they have given us a big formula that it may scare. It scares very many students. They have told us there Z equals 1.03A plus 3.07B plus 0.66C. Very easy, really. I can't get a fail in AFM. No, it's not possible. Not possible. Yeah. So then they have told us how to get these ratios, isn't it? They have told us how to get these ratios. They have told us A is net working capital. Net working capital. Yeah. All over what year? All over total assets. So then I would want to give you 2 minutes. I want to see whether the students will be able to give me the value of A, the ratio of A. Ratio of A, net working capital, all over total assets. Let me see whether there is somebody who will be able to give us a 𝗕𝗙𝗠 Limited, Beatrice Mwangi, yes. Net working capital, all over total assets. Let's see. Go to the table, there is a table where this examiner has given you values. Yeah, yours is to pick them. And then you substitute here. So net working capital, yeah, Shayla is giving me, let's see. So the net working capital I can see from the table is 1777. 1777, all over total assets, which are also given down there. Total assets, where are they? Up there actually. 49, 579. Remember this is negative or minus, it doesn't matter. So minus something, isn't it? 4 decimal places, minus 0.03, 0.0357. The more the decimal places, the better for us. The better for us. Remember 1777 is in brackets, negative, right? Delegate is in brackets. So first of all, let's agree about this. Is this answer correct? I can see some silence there. Yes. Rounding off errors, those are expected. Now, number 2, we go to the second ratio. Let's go to the second ratio. Second ratio B is operating profit over total assets. So B is operating profit over total assets. Yeah, let's see there. Operating profit over total assets. Before A. Oh, EZ. Are you talking about this Z? Z. My handwriting is very bad. Z. The equation is given on top, Mary. The equation is given there on top. It's given by the examiner. Z score. It's given by the examiner. Z is 1.03A. Yeah. So operating profit is the same as profit before interest and tax, PBIT. Operating profit is PBIT. Yeah, operating profit. Yeah, it is the earnings before interest and taxes, 2605 over 49,579. Please never forget, anytime you see operating profit is the same as PBIT, like that. Don't ignore the negative sign. It has to be there. It's part of the game. You can see even in mine, maybe it's not very, very clear, but it's there. We can't ignore it. All right. So this one I'm being given an answer as a 0.0525, 0.0525, like that. Thank you very much. So that's B. From there, we go to C, ladies and gentlemen. So C, what do we have here under C? Under C, they have given us something nice there. So under C, what they're telling us under C is net profit before taxes. Now after interest, net profit before taxes, yeah, all over current liabilities. So then this profit before taxes will be PBIT minus interest. And PBIT, you guys have given me 2605. Is there anybody who is able to see our interest from the question? Interest amount from the question. Ruth has been able to nail it. Yeah, it's given on the last paragraph that the company is currently paying interest on long-term debt instrument of 905. Please cut the 3 zeros. Remember, our table up there is in shillings thousands. So 905, 2605 minus 905, which then will end up giving us a what figure? 2605 minus 905. So this gives us 1700. Thank you so much. The other thing that we wanted to hide from these students is this current liabilities. I want to give you 1 minute. You give me the current liabilities in this question. Let me give you 1 minute. You give me the current liabilities in this question. Let me give you 1 minute. You give me the current liabilities in this question. Let me give you 1 minute, and you give me the current liabilities in this question. $14, $12, all right. Thanks for trying. Let's do it together. So they have told us, ladies and gentlemen, that you can see the last paragraph, that the company's total liabilities is constituted in the ratio of 2:5 between current and non-current components. Yeah, so in this case here, current is 2, non-current is 5. Non-current is 5. So 2 is to 5, right? 2 is between current and non-current components. Meaning that the current will be 2 over 2 plus 5, which is the same as 2 over 7. So the current will be 2 over 7 of total liabilities. Total liabilities. Total liabilities. Of which the total liabilities from the table given. Total liabilities from the table given. Total liabilities from the table given. Yeah. Total liabilities, they are 5044. 5044. 5044. So are you able to give me this figure? Yeah. 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 The more the decimal places, the better. Don't give me a whole number. I know it's not a whole number. 1441. 1441.1428. Thank you so much. Yeah. So then get back to our net profit before taxes. So we have this as 1,700 divided by our current liabilities of 1441.1428. What figure are we getting at the end of the day as our C? $1.179. So this is 1.179. 1.179. 1.1796. Like that. Yeah. So remember, Nelly, is it Nelly or Kelly? Nelly. So in this case here, they have told us in this question, they have told us the company's total liability is constituted in the ratio of 2:5. 2:5 between current and non-current components. So current has these 2, non-current has 5. So then our total liabilities component will be 7. Total liabilities will be 7. Yeah, such that the current then will be 2 over 7. Yeah, and non-current will be 5 over 7. I'm so sure in this semester, most students worked with 2 over 5. 2 over 5, that's what most students were doing. 2 over 5. Current, no. Nelly, I hope you're able to see that. Yeah, in the capital structure, it will be 2 over 7 as the total current. Yeah, great. So then this figure already we have it. Then D, you guys will be able to do D very well for me. You guys will be able to do D very well for me. I'm 100% sure. You'll be able to do D very well for me. You'll be able to do D very well for me. D equals who? D will be equal to who? D will be equal to who? D will be equal to who? Sales over total assets. Sales over total assets. Sales over total assets. So sales, we have our sales. At times they call it revenue. Your accountants should be able to know that. So sales is 25,678. 25,678. All of our total assets, total assets, we have them somewhere. 49,579, which then will end up giving us what figure, ladies and gentlemen? 0.5179. 0.5179. Therefore, our Z score, the formula is here. 1.03A, A value, we can see A value is minus 357 plus, we have here 3.07 times B, which is 0.0525 plus 0.66 times C, which is 1.1796 plus D, 0.4 times D, which we got up here at 0.5179, like that. Yeah, so Z then will be equal to what? Abracadabra with your calculator. Don't forget this negative. Don't forget the negative. Abracadabra with your calculator. Now you should be able to give us this answer. With your calculator, you should be able to give us this answer. with your calculator, you should be able to give us this answer. Yeah, so they're getting 1.1010. All of us, let's confirm this. Are we getting 1.1010, 1.1010, or 1.11? Well, that's okay. 1.11, right? 1.10995. Okay, 1.11. Yeah, and then of course we have our threshold of 0.862. This one you cram, eh? Yeah, this is the benchmark. The benchmark. Yeah, and our 1.11 is more than 0.862. Is more than 0.862, meaning that the firm is liquid. The firm is liquid. What is the name of the firm? Going to be Wanda? No. It is 𝗕𝗙𝗏, eh? It's good to use the name. 𝗕𝗙𝗏 Limited is liquid. So the firm, which is 𝗕𝗙𝗏 Limited, is liquid. It is not bankrupt, i.e., it is not bankrupt. 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 So remember this threshold, you cram it. Yeah, when you get in this case here, your Z is less than this, you say our firm is bankrupt. Yeah, our firm is bankrupt. Yeah, great. So have you, we have now come to the end of the lesson, right? I believe you've been able to pick something out of this. I believe as you march out of this session, ladies and gentlemen, you are okay now. If you get this kind of a question on exam, you'll be able to tackle it. You will tackle it. Yeah, great. Yeah, the 0.8, just like the ones of Altman's, those threshold there, those benchmark values, you cram them, eh? It shall not be given to you. You cram it, use it for one something months, you forget about it. Yeah. Where does it come from? Just like, for example, how you are being given like pi. You remember like pi is 3.17? You're forgetting these things very fast. What I remember, it was 22/7. Do you remember this pi? In high school. Yeah, something like that. It is ever there. It is cast on stone. You cram that number like that. But this one should now come in August. So we started with a very